FET, and we'll discuss the timing for FFR liftoff, and if necessary, any further accommodations. We'll begin by taking a look at real GDP growth. All information suggests that GDP is expanding at a moderate pace. If you take note in quarter 1 of 2015, you see that GDP growth was 26%. This was fueled mainly by a decrease in fuel prices. If you take a look at 2014 quarter 1 and 2015 quarter 1, both decelerations in GDP growth were also attributed to a harsh winter. Overall, sustained growth has been fueled by an increase in housing and personal consumption. However, in fiscal year 2015 quarter 3, we see that growth jumped down to 1.5%. When we look at the details of GDP growth from quarter 2 to quarter 3, we see that while consumption stayed at relatively high at 2.2%, inventories dropped 1.4%.
An already sluggish exports market has dropped to a near zero growth rate over the past quarter.
Next, we'll take a look at consumer confidence.
On consumer confidence, Common Score Index is currently at 97.6. The University of Michigan Index is currently at 90. During the recession of 1981 to 1982 for 16 months, the total confidence was at 65.5. The total average for 56 months was at 69.4.
Next, we'll take a look at industry.
Looking at the ISM curve, we see that both curves are above 50, signaling growth. Looking at the ISM non-manufacturing index, we see that the rate has increased from 56.9 to 59.1 due to a 6% increase in new order of service products. The ISM manufacturing curve has decreased from 50.2 to 50.1 due to low exporting and low inventory.
Next, we'll take a look at inflation.
PCE inflation from September 2015, the headline PCE was 0.2%, while the core PCE was 1.3%, which is below our target inflation rate of 2%.
Now, it's important to note that PCE is low, but it's nowhere near our lows of 2009.
But the headline PCE value is well below the value of the recession period of 2002. The headline CPI in September 2015 was 0.2%, while the core CPI was 1.8%, also well below our target inflation rate of 2%. The gap between these values is due to a 3.1% of a CPI shelter. The dramatic decrease in the headline CPI and PCE from 2014 and 2015 is due to commodity inflation. We can see that the prices of gold, copper, corn, and especially crude oil have decreased dramatically, showing a downward trend of the graph. This foreshadows a low inflation rate from the short to medium term.
Next, we will talk about and discuss housing.
Now, we're down from an all-time high of last year, but we still have very high rates in housing affordability. With a figure of 150, that means that only 2/3 of the average household income is necessary to buy your average home. That's a great figure for housing. Now, our housing indicators are all high. Our housing starts and permits have seen great growth over the past few sectors. New single-family home sales and existing family home sales have both seen similar growth rates, which is great. We're approaching a near 2006 high in those sectors. Now, home ownership values and household net worth see a very, very similar trend due to the fact that household values are so heavily weighted in equity. Household values going up are driving them directly. Now, the Case-Shiller Natural Home Price Index has seen an all-time high. We've seen a high demand and low supply housing market right now, which is pushing us towards the 2008 numbers, which caused the last housing bubble.
Next, we'll discuss unemployment.
Unemployment rates are currently on a downward trend. The current U3 unemployment rate is at 5%. The current gap between the U3 and U6 unemployment rate is 5.4% differential, which is down from the 2011 7.1% differential. Though the gap is closing, it is still a wider margin than in previous from recession, which was at 3 to 4%. It's important to note that the
it's also important to note that the gap is due mainly to marginally attached workers, part-time workers, and discouraged workers as well.
Now let's take a look at duration of unemployment. This is still a problem compared to previous to recession. As you see, median duration is still high, higher than 10%. There is room for improvement. Average hourly earnings, typically after 4 years we see an improvement, but not this time.
Now, the discrepancy between hourly earnings and the cost of employees could be described by the larger companies not believing this is a permanent factor. If this is temporary, they're going to be far less likely to provide sales increases.
From the payroll survey, the number of jobs created since 2011 has increased. However, recently jobs have decreased and needs to be monitored. The number of jobless claims are under 300,000. That is a good indicator of the labor market.
All right, given that information, we'll discuss equity markets.
The S&P 500 is at an all-time high before the August correction. The index is stable. The VIX index is stabilizing, as well as the overall market looks as though it's stabilizing.
Quarter 1 and quarter 2, U.S. big companies' profits and earnings have gone down, which is a reason to monitor this closely.
The real value of the U.S. dollar has appreciated, and this has caused net exports to decrease, all except for the petroleum balance.
Okay, we're going to discuss external factors next, starting with the EU economy.
When we look at the EU real GDP, we can see that the quarter 1 of 2015 was 1.2%, and it increased to 1.5% in quarter 2. Even though quarter 2 increased, this increase is not close to the percentage that EU would like to see. So European growth is sluggish. In September 2015, the EU unemployment decreased to 10.8%, which is the lowest rate, but it is still high. In October 2015, the EU's core inflation rate increased to the highest value of 1%, but falls short of the 2% target. Even though there is an improvement to the EU economy, we are waiting to see further improvement. But if the growth of the EU stays slow, there is a chance of a spillover effect that might occur onto the U.S.
China's real GDP growth was most recently recorded at 6.8%, and the IMF forecast that it could drop down to 6% until around 2020. This could affect the world economy by dropping it between 25 and 50 basis points, and the U.S. GDP growth rate by more than 25 basis points. The Chinese yuan has been greatly depreciated to boost net exports, and this could cause a serious negative impact on the U.S. exports.
All right, next we will discuss fiscal policy.
Okay, it can't be argued that fiscal policy is sustainable at the current time. We're over 100% of our current real GDP numbers with our deficit numbers. With $56,000 per citizen, and more importantly, $153,000 per taxpayer, we're seeing a large long-run issue. And we kind of expect some decrease in government spending over the next few quarters, as we've seen in the past couple, but we still need to do something to combat this problem. Now, utilizing Taylor's rule, low inflation numbers, along with a large gap between real GDP and our imposed GDP, is creating a negative target federal funds rate, another large problem. Now, current monetary remains very accommodative. We're still seeing large growth within the Federal Reserve balance sheets from our QE1, QE2, and QE3 purchases. We're still seeing turnover from our maturing reserve purchases as well as mortgage-backed securities. These are both buffering our bank reserves and creating market stability. A low federal funds rate and a near zero reserve ratio was not sufficient to create the growth necessary, so we did take extra measures. Now, we used QE1 and QE2 to bail out large banks and allow banks to give out better interest rates and more mortgage lending. We used QE3 to reach lending facilities to reach the smaller markets, private consumers, and small business sectors. They were very effective. We're still seeing growth in these things. I do believe we need to create a new monetary policy that looks at the numbers we're seeing in the current GDP realm, and it might be time to start talking about raising the federal fund rate.
Current GDP forecast suggests forecast is very promising and illustrates response from our current policy. However, given that we have examined all the information on today's economy, I would like to open up the floor for suggestions on where we move monetary policy forward. Yes, anybody like to move that?
Yes, even given the recent improvement in unemployment, we cannot be satisfied with these numbers. I would like to motion to keep the target federal funds rate where it is to see further improvement in the labor market.
I agree, and to fully satisfy our dual mandate, we need to make sure that our target federal funds rate of 2% is met. If not, we risk losing our credibility.
I think those are good points. I'd like to raise the federal funds rate. I think we need to combat raising housing prices, and I think that we need to keep them away from the '08 highs. And I think that a higher interest rate coupled with our heightened requirements for mortgages is going to be very effective in doing that.
Those indicators may be true, but market indicators like the S&P 500 is high, but the earnings are low. And there's still room for growth, so I think we need to wait and keep the federal funds rate where it is.
I agree with Mark, however, I think the heightened mortgage requirements are already stabilizing the housing market from reaching housing crash.
Okay, I think you guys are making good points. Allow me to suggest something a little bit less radical. What if we keep the federal funds rate at the same current rate, but we stop pumping the money that we're earning from our previous reserve purchases back into mortgage-backed securities? If we stop inserting money into the GDP, I believe that the allowances for the lower inflation ratings could continue GDP growth without accelerating them too high. It gives us an opportunity to look at these numbers in a slower average, but we're not going to see the same risk that we see with raising the federal funds rate.
Okay, I agree with your plan, I absolutely think that can work. However, I don't think that the members have had sufficient time to analyze that plan. So we should table this for conversation at the next meeting. However, I would like to take an official vote as to where we move forward. I heard 3 motions to maintain federal funds rate at 25 basis points, or maintain interest rates at 25 basis points. All in favor say aye.
Aye.
All against say nay.
Okay?
Ayes have it. So, in summary, GDP growth slowed due to weather-related issues in 2015 quarter 1, 2014 quarter 1, but strong rebound in quarter 2. Q3 growth was pulled down by inventories, core PCs below target. We'll keep accommodation low for now and keep the target federal funds rate as is. At the next meeting, we will discuss buying more long-term assets, consider a reduction in the interest rate that the Fed charges banks for discount window loans. Expectations for the first rate hike and pace of tightening at the next meeting. This meeting is adjourned. Thank you.
Thank you.
So on your results, you want to keep percent where it is right now. What's the trajectory? Even if you disagree on exactly what we thought should happen, what's the trajectory you think?
I believe that I believe that the unemployment rate will continue at a downward trend, and the gap between the U3 and U6 unemployment will get smaller.
No, I think that while we don't all necessarily agree on the decision to change the federal funds rate, we do agree that our sustained growth is a good and very important thing. We don't want to stifle that. We just want to slow it a little bit so that we have an ability to more thoroughly examine external factors like those markets. We are a little concerned about the housing market, but we do like some of the things that we're seeing, like in the 400-500 companies. So we don't want to impact those too heavily. We just want to slow things down a little bit so on a meeting-to-meeting basis we have a better understanding of exactly how these things are playing out.
To clarify, and then over the next few years, what do you see as the trajectory?
I would like for us to stabilize very quickly. We're seeing a lot of growth, so we're not too far from getting to the numbers that we'd like to see in both unemployment and inflation figures. I think that we don't expect too many quarters before we're going to reach those figures. So I would say that within 1 year, we'd like to have a federal funds rate that's looking at stabilizing the GDP as opposed to slowing growth.
I would predict that GDP growth is going to remain relatively stable and trend, given current growth rates. And like you said, utilizing the components of Taylor's rule, personally, I just don't believe that it's time yet to raise the federal funds rate, given external factors. So,
So you guys mentioned the federal funds rate and the size of the balance sheet as being accommodative monetary policy. So I was wondering if you could tell me some more about how exactly you would go about measuring
back to the Federal Reserve. These are huge things because they allow for market stability, which is a very, very big part of what we're trying to get done here today. So further, like, we're trying to get our dual mandate situated. If anything that we do moves us towards that goal of market stability, low unemployment, these are things that we can say our current monetary policy is doing, and I believe that those are things that we should be looking at in the forefront.
Do you have any thoughts on the Fed increasing, even if only temporarily, the inflation target? Just something on that.
The thing is that if the Fed increases the inflation target now, that we would be moving away from our target inflation rate, because our inflation rate, as we saw, the PCE and the CPI, is relatively low compared to what we want. If we raise it now, then we will be moving farther away from our target, which would send a very bad message to our consumers, and we would lose our credibility.
I think that as market indicators are currently saying that we need a target federal funds rate of below 0%, the option of stifling growth to that degree is very scary. I think that the growth that we're seeing within most sectors is a very, very big portion of what we're hoping to see. And I think that if we do raise any interest rates, it needs to be very slowly and very, very reached out over very lengthy periods of time.
I think something that we need to keep in consideration is external factors such as foreign markets. And some of these foreign, as we've seen currently, the EU and Chinese banks are beginning to raise their interest policies or interest rates, which is going to affect us. One thing I would not want to do, and when we couple that with things like artificially low gas fuel prices, we create a situation where we can find ourselves above that target rate very quickly. And I think this is something that the bank needs to, that we as the FOMC need to keep in mind as we future predict. Taylor's rule is important, but we also need to look at other factors. So we need to start looking at some of those other factors, such as the Chinese banks and what their monetary policy would be, and we need to be able to respond quickly and not get caught behind in the lag.
Now, as we are seeing Fortune 500 companies doing very well, their revenues, as we said, are very low. So adding another expense to their budget would hurt them a lot. And we don't think that that's a good time, that this is a good time for that action.
So in terms of Fed's communication policy, could you give me a recent example of a really good or effective form of communication the Fed is engaged in, and maybe give an example of maybe a mistake or relatively not effective communication that the Fed is engaged in?
I think that some of the actions we've taken over the past couple of years were very ineffective. Unfortunately, during quantitative easing, QE1 did not reach the consumer basis. We did bail out banks. We did a great job of getting them to the point where they could lend out more money, but it never left the banks. Unfortunately, there was so much damage done prior to these actions that they felt like they had only been helped. We did use lending facilities later on to, again, saturate the lower markets, reach these smaller businesses, reach the consumer, and the ability for the consumer and small business to go directly to the Fed to sell those policies was great. In terms of actual marketing, I believe that the biggest indicators we can send out are to just continue telling people that we are seeing growth. I think that raising the federal funds rate could potentially tell them that. I think going forward, letting them know that we're in a good position, that we're not scared to do something like that could be a great sign.
Recently, the chairman has given some indication that recent FOMC meetings we've given indications that we may possibly raise rates, which has kind of had a shock to the markets. And we've done this a couple times through our meetings, and we've not raised the rates yet, and we kind of see the results. Recently, at the last FOMC meeting that we conducted, we signaled that we possibly may be bringing rates forward, and the market responds to that accordingly. So, adding to what he's saying, we want to make sure that we remain legitimate in the eyes of the banks and the consumers on a local level.
And I think the VIX index reflects that we've been doing pretty well with that. We did see a drop before a more recent flattening, and I think that flattening is very important for our market stimulation. And if we make any moves right now to shake that up, we would.
Ms. Yellen just recently gave a speech about possibly raising the rates at the next FOMC meeting, and that will, without a doubt, have reactions either negative or positive. We'll wait
think that's going to rely a lot on our up-and-coming election. I think depending on who ends up in the White House, we could see a huge change in who's coming in and out of the country. I think that more importantly, in the long term, are outside factors like Chinese and European economies, because we're so deeply impacted by them without them actually coming within the United States. As far as our actual production values, I do think that the immigrants are a huge asset. We've seen large growths of immigration to the United States along with the large amounts of growth we've seen in GDP over the past few quarters.
I think something that we need to keep in mind too is the Hispanic population is the fastest growing population in the United States. And with that, they bring a different mindset and a different way of what they're going to be looking for in products is going to be much different than what other demographics are looking for. So this is something that I think we must absolutely accommodate for. Make changes.
What about demographic change such as aging?
Now, we do expect that since we've seen a significantly lower over the past few quarters government spending hikes, I do believe that that could, in the long run, reverse. Because of our actions taken for Social Security and also for aging people in the healthcare department, I think that government spending is inevitable in the long run. I believe that some of our relations and our interactions with those aging populations are going to be very, very heavily weighted in terms of our deficit. And I do think that we have a deficit that's going to grow for the next years, for as long as we're looking forward.
Yeah, and it's important to note that the baby boomer generation, which is much larger than subsequent generations, is retiring. And with that, they're on the short hand, they're moving large amounts of money, but on the long term, we will see less consumers from current demographics, and we may have to rely more on immigration.
What would you propose the Fed do if suddenly China and or Europe face a major economic crisis? So how should the Fed react?
I think it's safe to say that they're pretty close to doing that right now. I think that the Chinese economy is very low at the moment, and I think that the biggest impacts on us are incorporated in our exports. Before the Chinese and European markets went down, we were very, very heavily trying to reduce the value of our US dollar to impact our exports markets. Now, we have not been able to do that since those industries went down because our exports have taken a large hit because of it. Now, we are seeing a great reduction in production within the United States, but we're seeing service trends and other trends go up. So we are still consuming. Now, as one of the largest consumer countries in the world, I think that our part is to continue to purchase from these other countries and ensure that their GDP does see growth.